Like many of you, I started trading with every single indicator possible. RSI, MACD, Stochastic. You name it, I had it on the chart. After losing multiple funded accounts, I realized something crucial about indicators that changed everything. Before I show you exactly how I discovered, let me ask you something. Have you ever had a perfect indicator setup fail? Or worse, have you ever missed a massive move because your indicators weren't aligned yet? Here's what nobody tells you about trading with indicators. When I first started trading, my charts looked like a Christmas tree. Multiple moving averages, 3 different momentum indicators, Fibonacci levels everywhere. You get the picture. I thought I was being thorough or even professional, but here's what I was actually doing. I was building a psychological crutch. See, here's what happens when you rely on multiple indicators. You're not actually getting more information. You are just looking at the same information in different ways. But psychologically speaking, it feels safer. It feels like you're being more careful, more analytical. Let me give you a real example. Last month, I was watching a friend analyze a setup. Price was making lower lows and lower highs. Clear downtrend, right? But he wouldn't take the trade. Why? Because his RSI wasn't overbought yet. His MACD hasn't crossed. His stochastic was, well, somewhere. By the time all his indicators aligned, price has already moved 100 pips. This brings me to what I call the tree. The first thread, the need for confirmation. This is where most traders get stuck. You see the setup, but you need your RSI to confirm, then you need your MACD to confirm the RSI, then you need the moving average to confirm your MACD. You are not looking for confirmation. You are looking for permission. Permission to take a trade you're already scared of taking. Illusion of certainty. Now here's a hard truth. Adding more indicators doesn't make you more certain about a trade. It just gives you more ways to talk yourself out of it. Or worse, more ways to convince yourself to stay in a losing trade because this indicator hasn't turned yet. The third thread, the analysis paralysis. This one's subtle but deadly. The more indicators you have, the more variables you need to analyze, the longer you take to make decisions. In trading, speed of execution matters. Not reckless speed, but decisive speed. Here's where it gets really interesting. The problem isn't the indicators themselves. The problem is how we use them. We use them as a way to avoid taking responsibilities for our trading decisions. Think about it. When a trade goes wrong, what's the first thing most traders say? But my indicator said whatever. Now you might be thinking, okay, but don't we need some kind of analysis too? But here's the crucial distinction I learned after blowing multiple accounts. There's a difference between using tools and depending on tools. Think about driving a car. The speedometer is useful, but do you stare at it constantly? No. Most of the time, you're looking at the road, aware of your surroundings, feeling the speed of the car. The speedometer is just there to confirm what you already know. Trading should work the same way. Price action is your road. Market structure is your surroundings. Indicators, they should be your speedometers. Something you glance at occasionally, not something you stare at constantly. Now I know many people are able to be profitable using only indicators. I know that. Different strategies work for different people, and trading based on indicators just doesn't work for me. So how do you make this transition? How do you go from depending on indicators to trading price action? Let me share exactly how I did it, and more importantly, what I discovered through extensive backtesting. If you need a tool to track your backtested trades, check out the link in description below for my free trading journal. Also, check this video here where I talk more about backtesting. Here's what changed everything for me. Instead of just removing indicators and hoping for the best, I spent 8 months backtesting pure price action setups. When I first removed my indicators, I felt blind. Like I'm trying to drive a car with a blindfold. But as I started backtesting, something fascinating happened. I began to see patterns I'd never seen before because they were hidden behind all those indicators. Let me break down exactly what I discovered through my backtesting. The first revelation, my win rate actually dropped to 21%. Now, most traders will panic at this point. I almost did. But here's what the data showed me. Even with this lower win rate, I was more profitable. Why? Because I was catching bigger moves. My average winner jumped to 3.92R, while my average loss stayed at 1R. Second revelation, price action setups were giving me clearer exits. I was always conflicted. Should I exit because the RSI is overbought, or should I hold because the MACD hasn't crossed? With pure price action, my exits become simpler and more profitable. But here's the most important discovery. Through backtesting, I found that market structure was giving me everything my indicators were trying to tell me, just in a clearer way. Instead of waiting for the RSI to show oversold, I could see exhaustion in price action. Instead of waiting for moving averages to cross, I could see the shift in market structure. Let me give you a real example. In my backtesting, I noticed a pattern that kept repeating. Price would make a strong move, then consolidate. I would have waited for some kind of crossover or signal. But price action was showing me something clearer. When that consolidation broke in the direction of the trend, it led to another strong move. This pattern alone, once I seen it hundreds of times in my backtesting, became more reliable than any indicators combined. Why? Because I wasn't just looking at mathematical formulas. I was actually looking at actual buyers and sellers' behavior. But here's where most traders mess up with backtesting. They focus only on winning trades. I did the opposite. I focused on winning and losing trades. I studied my winners and losers. Why do they fail? Why do they win? What did I miss? This is where the real learning happened. After analyzing over 3,000 trades, patterns started emerging. I could see why certain setups fail and others succeed. And more importantly, I started to understand the context around each setup. It wasn't just about the pattern, it was about where the pattern occurred in a larger market structure. This extensive backtesting did something else. It completely transformed my psychology. When you have seen a setup work hundreds of times in your testing, you don't need any indicators to give you that confidence. This confidence comes from experience, from knowing you have done your homework. Think about it. What gives you more confidence? 3 indicators aligning, or seeing the same price action setup play out successfully hundreds of times in your testing. This is why I tell every trader, don't just remove your indicators and start trading price action. That's a recipe for disaster. Instead, spend time backtesting. A lot of time backtesting. Study the market like you would study a language. Learn through immersion. Let the pattern emerge naturally. Remember, the goal isn't to trade with less information. The goal is to trade with clearer information. Through proper backtesting, you are not just learning to trade without indicators. You are learning to see what's actually happening in the market. Now here's where it gets really interesting. And honestly, this is the part that took me the longest to understand. Trading with fewer tools doesn't mean trading with less information. It means trading with clearer information. Let me explain something crucial about trading psychology. When you have 10 indicators on your chart, your brain tries to process 10 different signals. That is not analyzing. That is chaos. It's like trying to listen to 10 people talking at once. But when you focus on pure price action, something amazing happens. Your brain starts to recognize pattern naturally. It's like learning a language through immersion rather than memorizing grammar rules. If you want to learn more about trading psychology, check out this video here where I talk about why your trading psychology is weak. Next, risk management adjustments. This is absolutely crucial. When you transition to price action trading, your risk management needs to change too. Here's exactly how. First, your stop losses becomes more precise. Why? Because you're placing them at a logical price point, not indicators level. You're not putting your stop just below the 200 EMA. You're putting it where the price action tells you your trade idea is wrong. Second, your position sizing becomes more dynamic. With indicators, many traders use fixed rule like sell when RSI hits 70. With price action, you learn to read the strength of a setup and adjust your position size accordingly. Third, and this is crucial, you start managing trades based on what the market is showing you, not what your indicators are telling you. Let me address the most common challenge you faced during this transition. Number 1, fear of missing out, or FOMO. Without indicators, you might feel like you're missing information. Start keeping track of the trades you will have taken based purely on price action versus your indicator-based setups. I guarantee you'll be surprised by the results. Number 2, lack of confidence. This is normal. You are learning a new skill. The solution? Backtest extensively. Give yourself undeniable evidence that your strategy is working. Don't trade live before that. Number 3, overtrading. Without indicators to restrict, you might feel tempted to take more trades. The solution? Make strict criteria for what constitutes a valid setup. No setup, no trade. Here's what finally made everything click for me. I realized that indicators weren't actually helping me make better trading decisions. They were just helping me feel better about my decisions. But feeling better about a decision doesn't make it a better decision. The market doesn't care about your indicators. It doesn't care about your moving averages, your RSI, your MACD, right? The market only cares about supply and demand, buying and selling pressure. When you start trading pure price action, you're not trading with less information. You are trading with better information. You're seeing the market for what it is, not what your indicators tell you it is. So here's what exactly I want you to do starting tomorrow. Stop trading in the live market. Go and learn about price action. Start to backtest. Keep your indicators for now, but start making trading decisions without looking at them. Take trades based on price action only. After each trade, review what your indicators were saying. Then, start removing indicators one by one. If you are able to find confluence between price actions and indicators, feel free to keep them on your chart. And lastly, focus on understanding why price is moving, not just where it's moving to. Remember, the goal isn't to never use indicators again. The goal is to stop depending on them. To use them as a tool, not crutches. Trading doesn't have to be complicated. In fact, the simpler you make it, the better you will trade. Focus on price action, market structure, and risk management. Everything else is just noise. Let me know in the comments what indicators you're currently using and why. Remember, the best traders aren't the ones with the most indicators. They are the ones who can read the market story through price action. Start writing your own trading story today. Hey, if you like this video, then make sure to check out this video where I talk about the number 1 reason why traders keep failing.